just a few days, a nearly $7 billion VinFast deal sent shockwaves through the financial world. Not because the Vietnamese EV maker unveiled a groundbreaking technology, but because of how it attempted to make almost its entire debt burden disappear from its balance sheet. To some, this is a bold restructuring move that could save VinFast's future, but to international analysts, it raises serious red flags about transparency, corporate governance, and systemic risk. The biggest question now is this: is VinFast reinventing itself for survival, or simply buying more time before a much larger financial reckoning arrives? When VinFast first appeared on NASDAQ, the company was celebrated as a symbol of Southeast Asia's rising industrial ambition. From a relatively unknown Vietnamese automaker, VinFast rapidly entered the global EV race at unprecedented speed, building factories, opening showrooms across the United States and Europe, expanding into Indonesia and India, and launching multiple electric vehicle models while spending billions to compete against Tesla, BYD, Hyundai, and other giants. But hypergrowth always comes at a price. After years of aggressive expansion and heavy cash burn, VinFast now faces enormous financial pressure. Reuters reported that the company lost nearly $3.9 billion in 2025 alone and has never posted a profit since its founding in 2017. In response, VinFast recently announced a controversial restructuring plan, selling its Vietnamese manufacturing assets to a group of investors while transferring nearly $6.9 billion in debt to a newly structured entity. If completed, VinFast would effectively become a lighter asset company focused on software, research, design, and product development instead of directly owning manufacturing infrastructure. In theory, this resembles the strategy used by many modern technology giants. Apple does not manufacture iPhones itself. NVIDIA does not build semiconductor factories. They focus on design, branding, and core technology while outsourcing production. VinFast appears to be attempting a similar transition, but there is one major difference. Apple adopted this model after becoming massively profitable. VinFast is trying to do it while still drowning in losses. And that is exactly why investors are nervous. According to Reuters, the structure of the transaction is unusually complex. The factories are expected to be transferred to investors connected to Ferd, a company previously linked to VinFast. Reuters also noted that Nguyen Hoai Nam, the businessman who recently took over Ferd, has connections to Vincom Retail, formerly part of the Vingroup ecosystem. For analysts, the concern is not merely the restructuring itself, but the speed and opacity surrounding the ownership changes before the transaction was announced. Reuters cited financial analyst Mehdi Jawadi, who said the strategy makes sense financially, but also contains multiple governance red flags. In simple terms, markets are asking a difficult question. Is this truly an independent market transaction, or is it simply debt being shifted between interconnected entities within the same corporate ecosystem? Another controversial point involves the ownership structure after the deal. Initially, 3 parties were expected to participate in acquiring the assets, but eventually only 2 remained as primary holders. A company called Ngoc Quai briefly appeared during the restructuring process before disappearing from the final arrangement, raising additional questions about its real purpose. In global finance, overly complicated structures rarely inspire confidence. The more layers of intermediary entities involved, the greater the fear that risks may be hidden beneath the surface. However, from another perspective, VinFast may simply have run out of alternatives. The global EV industry is entering a brutal consolidation phase. Tesla's growth has slowed. Multiple American EV startups have collapsed or seen their valuations implode. Chinese automakers such as BYD have launched an aggressive price war that is crushing profit margins across the industry. VinFast, with far fewer resources than its global competitors, may no longer be able to sustain a strategy of simultaneously manufacturing vehicles and expanding worldwide without deep restructuring. What is particularly interesting is that VinFast is not abandoning everything. Reuters reported that the company is retaining its factories in Indonesia and India while continuing to hold key patents related to next-generation EV technologies. This suggests that VinFast is not retreating from the global EV race. Instead, the company is trying to survive long enough to remain in the game. In many ways, this could become a Vietnamese version of the asset-light strategy adopted by modern tech companies: reduce fixed costs, lower debt burdens, and improve financial flexibility. The problem is that today's market is far less forgiving than it was during the EV boom of previous years. VinFast shares reportedly dropped around 12% after the restructuring announcement, signaling that international investors remain unconvinced. Some Vietnamese investment funds see the situation differently. Dragon Capital reportedly argued that the deal could significantly reduce VinFast's financial pressure over the long term, and in reality, if successful, this restructuring could become a turning point for the company. Because the most dangerous thing for a high-growth company is not necessarily losing money. It is running out of cash before reaching sustainable scale. Tesla itself came dangerously close to bankruptcy multiple times before becoming a global powerhouse. Amazon also faced years of skepticism while posting enormous losses during its expansion phase. VinFast is clearly hoping it will eventually become the next Tesla rather than another failed EV startup. But there is an even larger story behind this situation: Vietnam's emerging chaebol-style economic model. Reuters previously reported that Vietnam has been increasingly encouraging massive private conglomerates modeled after South Korea's chaebols, with Vingroup standing as the clearest example. This strategy can generate rapid national industrial growth, but it also creates concerns about concentrated financial power and systemic risk. When one conglomerate simultaneously dominates real estate, retail, electric vehicles, infrastructure, technology, and energy sectors, any major shock can ripple far beyond a single company. That is why international financial markets are watching VinFast not merely as an automaker, but as a test case for Vietnam's broader economic ambition. If VinFast succeeds, Vietnam could create its first globally recognized technology brand. But if it fails, the financial and reputational consequences could be enormous. One particularly revealing detail from Reuters is that Foxconn, Apple's famous manufacturing partner, reportedly showed interest in VinFast's production lines as early as 2021. That detail suggests VinFast manufacturing assets may actually hold significant strategic value. As global technology companies continue exploring the EV industry, high-capacity production infrastructure is becoming increasingly important. If VinFast truly transforms itself into a company focused on software, engineering, branding, and vehicle design while outsourcing production, the strategy could dramatically reduce its capital burden. However, everything ultimately depends on one thing: real consumer demand. So far, much of VinFast's revenue still relies heavily on Vietnam's domestic market and companies linked to the broader Vingroup ecosystem. Reuters previously reported that a significant portion of VinFast sales came from affiliated businesses such as GSM and other Vingroup-related entities. That means the company's biggest challenge remains unchanged. Can VinFast generate genuine large-scale global demand for its vehicles? Without sustainable international sales, even the most sophisticated financial restructuring may only delay deeper problems. But if VinFast survives this phase, history may eventually look back at this moment as the turning point when the company finally cut away its financial burdens to fight for long-term survival. This $7 billion gamble is therefore not just an accounting story. It is a test of Vietnam's industrial ambition in the global technology race.